Hello and welcome to our presentation. This presentation is on the topic of future business loans, the impact of PPP and EIDL. The presentation is sponsored by CFO on Demand, which is a division of Fitzpatrick, Bongiovanni and Kelly, and Fulton Bank. My name is Lou Bongiovanni, and I'll be one of the presenters. My company is CFO on Demand, and we offer outsourced CFO services to small and medium-sized businesses. The other presenters will be Wendy Bartlett from Fulton Bank and Debbie Finley from Fulton Bank, the SPA lending division. Some housekeeping real quickly. The presentation will be about 30 minutes. About 20 minutes we'll do some presentations between the three of us within a 20-minute time frame or so, and then we'll allow the last 10 minutes or so for questions and answers. So we encourage you to click on the chat. Feel free to ask a question. No one will see your questions, and we'll answer them as we are able to. We hope that you enjoyed the presentation, and I'll be going first. So my perspective is I consult with small business owners who have lending needs often. As an outsourced CFO, our focus is helping business owners grow, and a big part of growing is being able to have the financing that you need to. So that's a perspective that I'm going to approach this whole question that has been swirling around since the pandemic, a little over a year now, is how is all this proliferation of loans to be managed by small businesses, where before a business owner would go under the conventional mindset of they borrow money if they can, and they have to go through this certain process. And now with the pandemic, there's a feeling that a bunch of loans are either available or thrown at people, and how do you manage that? So I think the first step that I would suggest is you really need to lean on your lender or relationship manager of the bank. They are truly your advocate to the loan committee. They also act as a liaison and can be an invaluable advisor for you to navigate through what loans you're eligible for and which ones are worth taking or not. Historically, when it came to borrowing and financing a business, I've often heard of the 4 C's. So I'm going to bring them up just as a backdrop here, because I still think very much so, these 4 C's and the concept of them is still very pertinent, even in this odd environment that we're in. So the 4 C's are cash flow, collateral, creditworthiness, and cash in the deal. And I'll briefly speak on each one of them. So the first one is cash flow. So when you're borrowing money from a lending institution, you want to make sure that you have enough cash flow generated from the use of those funds in order to pay back the loan. That's obviously very important to the lender and should be important to the borrower as well. So exercises such as doing monthly cash flow analysis or projections as to how you'll be able to pay back the loan are important. And also what's important are loan covenants. And these are usually imposed by the lender just to make sure that you're not overextending yourself as a business owner with this new loan and are able to manage it as best you can. So loan covenants might feel like they're restrictive, but they're actually serve as very good parameters for you and guides for you so that you as the business owner don't get overextended. The next C is collateral. You want to make sure that you have enough collateral in order to secure the loan. So as a lender, the lender is not only looking at your ability to repay, but if something happens, they want to make sure that you have enough collateral to secure the loan. So things such as personal guarantees, which is your personal commitment that you will satisfy the loan from your personal assets, even though it's a business loan, might be asked for, or looking at things such as real estate is usually preferable with these things. Items that are looked at when you talk about creditworthiness is your personal financial collateral is your personal financial statement, as well as your balance sheet. Next C would be creditworthiness. So the lender wants to make sure that you have a history of paying back loans, whether it's personal or the business, so they'll look at both, and they want to make sure that you as an individual are accustomed and have a good discipline as far as paying back your loan. So this is very important. So they'll look at things such as your credit report for the business, as well as you personally. And if there are any problems with that, they'll ask you to explain that further. So creditworthiness is very important. And it seems to have been strained a little bit with a lot of these initial PPP loans where that's not even a factor. So some people say, is that important anymore? It absolutely is important still. And lastly, cash in the deal. Under normal circumstances, a lender does not want to be the only one who's taking the risk or want to take an exorbitantly large percentage of the risk when a company needs to borrow funds. So they want to make sure that the company has something at stake here as well as the company, as well as the company owners. So they will ask for things such as sources of the funds, so they know how much the company is putting in or the owners are putting in, as opposed to the bank is putting in. So they understand what that balance is here. They understand the sweat equity that an owner might put in, but they also want the owner to be financially at risk. So cash in the deal, again, is also an important factor. And again, under this PPP and EIDL environment, that fact seems to have been gone by the wayside, because that's not a factor in many of in these loans. And then people are starting to question, are they important anymore? So again, I think in recap, those 4 C's are very important. They were before the pandemic, and they surely will be afterwards. Right now, they seem to be strained, and it's a little unclear as far as what of those things should be a factor versus not. And I'm here to tell you that they are still very good guidelines to follow. And I would highly encourage you to continue to consider those things. And when things get back to normal, I will guarantee you that lenders will be looking at them hard. Right now, they're giving you a little pass with that because of all the extraordinary things that are happening in the business community, but sure to be known that that will get back to normal. So now I'm going to pass it on to a relationship manager who can speak with more experience and more details, and that's Wendy Bartlett. Wendy? You want to unmute, Wendy?
That's the new word of 2021. All right, you're muted. All right. So thank you, Lou, and all excellent points. All things that bankers have always looked at and will continue to look for. Good afternoon, everyone. My name is Wendy Bartlett, as Lou indicated. I'm the commercial banking team leader for Fulton Bank in South Jersey. My office is located in Galloway, and my team covers anywhere from Burlington County south. I'm joined by my colleague, Deb Finley, who is one of our SBA lending specialists here in South Jersey. And the topic today, how PPP and EIDL will impact your future loans, is definitely an important topic today. As you all know, 2020 was a challenging year for all businesses, including banks. As we faced shutdowns of our customers' businesses, supply chain issues, declining demand. And on top of all that, we had to stand up this PPP process quickly as these rules were changing daily. We set up processes to defer loan payments for our commercial customers, anywhere from 3 to 6 months. And provide loans to borrowers whose financial condition, had been negatively impacted. So this was a big change for us. All these things created very unique challenges to both banks and to regulators. In normal times, deferring loan payments for 90 days would trigger, transferring a loan to non-performing or non-accrual status. So to the credit of the regulators, they really stepped up to the plate to allow banks to help their clients. And it was much appreciated. So on to the next slide. So what's next for 2021? How are the bankers going to analyze these 2020 financial results? The 4 C's of credit may have to be massaged just a little bit. As banks, they normally look to historical cash flow to determine a borrower's ability to service future debt. So as we know, many businesses' income statements and cash flow were impaired in 2020. How are we going to take that into consideration? How are we going to look at that? If we had debt service covenants that included current portion of long-term debt from fiscal year end 19, and then there were payment deferrals in 2020, how are we going to look at that? So, the banks also started discussions both internally and with regulators, early last year, as to how these things are going to be handled. And I guess the answer is it depends. We're going to have to look at each of these things on a case-by-case basis. As relationship managers, we are there to help our clients, and I don't think anybody's bank wants to penalize people for what happened in 2020. So some factors that banks will be considering with your financing requests in 2021, we're going to have to decide how we're going to treat the PPP forgiveness income in our analysis. That would be an extraordinary item. We would normally exclude that in our traditional cash flow analysis and covenant definitions. Obviously, businesses would not have had a lot of their expenses if they didn't have the PPP money. They wouldn't have kept employees on and so forth. So we'll have to take that into consideration. To look at how strong is the balance sheet, in terms of liquidity and leverage, after what they've endured in 2020. A strong balance sheet may help to mitigate any negative impacts that the 2020 income statement might reveal. We're going to look at the 2019 results, in conjunction with the 2021 interim financial statements, 21 projections, and we might ask for a monthly cash flow projection, as Lou had mentioned earlier. The important thing is that you talk with your relationship manager early. They are your trusted advisor. They're there to help you, and just keep the dialogue open so that they can assist you with whatever needs you may have. They may want a detailed explanation of how COVID impacted you, past or present. Is it still impacting your business? Whether or not the impact is over. So you might want to put something in writing that will make it easier for them to kind of explain that to whoever they may need to help to approve your loan request. So if your business was and continues to be severely impacted by COVID, conventional financing might not be an option. Lack of collateral, lack of cash flow, whatever the case may be. But in those cases, the SBA, under the Economic Aid Act, has put together several programs for you.
So there's a number of financing options available, and Deb nicely laid them out here. And really, it's important to understand what's available to you as a potential borrower and what works best for your situation. And this is a full-time undertaking because there is a lot of information going out there, from the PPP one that's probably gotten the most publicity because that's a forgivable loan, to things such as the EIDL loan, which has been very helpful. Previously, that was capped at $150,000, and now has been very recently, within the last 2 weeks, have been increased to a cap of $500,000, which was the original amount designated, but wasn't available originally. So you're getting people who are getting that second wave, so to speak, at the EIDL. The NJEDA also have a number of programs. One that is out now that's up to $20,000 that's offered there, and it's great because Debbie has added the links here for you as well to take advantage of. In addition to that, there are programs by SBA sponsored other programs such as microloans, and these have been around for a while, but now, especially with the needs that clients have through the pandemic, they're especially popular. And one is called CBAC, or Cooperative Business Assistance Corp. They're a great program. If you need up to $50,000, they're very favorable rates. I would encourage you to look into that as well. And there's another sister company, again, an SBA sponsored company called RBAC, which again has higher limits and some additional financing available than what you can be offered from CBAC. These are two great programs that are, again, under the SBA umbrella, which has proven to be just really a business lifesaver for so many businesses that need it. And number 6 here, the 7A loans are the most common ones. This is when people think of the SBA. The loans are out there. They are still out there. That's a 7A loan up to a $5 million limit, or the Express loan, which has recently been increased to a $1 million limit here as well. Again, excellent program. So thank goodness for the expansion of the SBA and the programs they offer as far as financing options. And then this, coupled with what the banking community is offering, is really been designated as the lifeline in order to get businesses to the next level. Debbie, anything there that I missed? We good? All right. So next slide. Okay. So next slide here. Current enhancements to the new SBA Economic Aid Act. And again, there's so many of these is changing at such a quick pace that, by the time some people see this, there might be changes to it. There are different provisions here as far as temporary increases, as mentioned with the SBA Express line of credit. Fees have been either waived or reduced for that. First months have been forgiven or deferred in some instances with SBA, and I believe they've been forgiven. So there's been a bunch of enhancers here, not only additional financing, but enhancers, again, to smooth out for the businesses that have been hurt the most. I think the real challenge from my perspective with these things is that, which ones are best for your company and really borrow what's needed. And Debbie and I have kind of spoken offline here in preparation for this meeting, but I think the thing that's important is the SBA is going to be mindful not to get people to over borrow and really just support a business that was hurting and artificially supporting it. I think that's really important that the SBA provide that service as well. This is a good thing, but as with anything else, too much of a good thing can really turn bad, and that is indeed the case with financing, just like anything else. This speaks specifically of the Economic Aid Act, and again, that there are enhancements here, and especially to the hardest hit companies, and how they distinguish those hardest hit companies. They do it by the NAICS codes that you probably didn't even know what yours was here, but as a result of the borrowing process, you learn what it was. So these listed here on the screen are the last 3 digits of your NAICS code. And if you fall within those, and most of them, or you've heard most of them here, there's additional benefits and additional help that they're providing. And here's a list of them. So educational services, the arts, accommodation, food services, that's been a huge one that's gotten probably the most publicity, but as well as air transportation. I'm just picking a variety of ones. Transport, rail or taxi or limousine service, rental and leasing of equipment, personal and laundry services. Those companies specifically have been identified as the hardest hit and are getting even more enhanced benefits. And the ones with the restaurants, I think, are probably the most publicized, or at least that's the one I see the most here. So, so that's a good list to know. And if you're in any of those industries, or you know someone who is, please make them aware that there are benefits over and above for those in particular. Debbie, anything else with that? Did I hit them? Great. Okay, so we're going to now go. We have about a little less than 10 minutes left, and I really hope we can get Debbie on here, but if not, I'm going to answer with her assistance any questions here. So, Wendy, are you unmuted?
I am.
Okay, perfect. All right. So, so a couple of questions here, and again, I invite anyone who has questions to type them into the chat. But as far as questions that I've gotten from business owners as it relates to banking is the loan covenants. And again, under conventional lending, loan covenants are critical. If you don't meet your loan covenants, that obviously jeopardizes renewals, it jeopardizes future lending opportunities, and it requires some things being done on the financials. So as it relates to loan covenants specifically, and I understand this year and frankly, 2020 and 2021 are going to be a challenge. How are loan covenants specifically being viewed in light of the PPP loan and the other ones like EIDL?
Well, I think as I mentioned, we're really going to have to look at those on a case-by-case basis. Bankers, as I said, do not want to penalize folks for factors that were beyond their control for 2020. So it's important to, as I said, begin the dialogue with your bankers or your relationship manager so that we can get an understanding of what happened with your business and what's, what you're projecting to happen in 2021. As I said, the regulators have given us a little bit of latitude, but there's a lot of businesses that did very well in 2020 as well. So that's why I say we have to look at it on a case-by-case basis. On one hand, should we include the PPP income? They wouldn't have had the salary expenses if they didn't have the PPP income in many cases, but in some cases that's not the case. So, again, it's on a case-by-case basis, and we will have to evaluate it, individually.
Debbie, as far as distributions or exorbitant salaries more than they would normally have, for those businesses that didn't get hurt as much or actually did well, the ones that got hurt probably did not have this issue, but the ones who maybe didn't get impacted as much, but that PPP money was there and they would have been foolish not to take it. How do you advise the business owner as far as that when there's excess funds there, they're tempted to take some out? I'm assuming they're feeling there's a reasonable amount there, but again, I would think that's on a case-by-case basis. But do you prefer that they talk to you about that? Hey, we have an extra $200,000 they wouldn't otherwise, and we're okay. Do you have a problem with us taking out part of it? Is that how the conversation would normally go?
Yes, I think that goes back to communication. Just to, let your relationship manager know up front what your intentions are, and so that we can have those kind of conversations. Obviously businesses that did well and have a lot of cash on the balance sheet and can afford to bonus a little bit out. That's their prerogative. We would prefer that as long as leverage remains reasonable and they're not sucking all the money out of the company. To your point earlier about having some skin in the game, but conversations should be had regarding that.
Yeah, so as long as it doesn't strain any of the ratios, not only loan-specific ratios, but whether it's the current ratio, debt-to-equity ratio, things of that nature. There's not only bank-driven ratios, there's other good financial ratios there. As long as they're not strained by this, then I would think they would have more of an argument to justify paying out some larger amounts if the PPP provided. Is that fair to say?
That's fair to say. I mean, obviously, it's in every business owner's interest to maintain a strong balance sheet. So, so if they have the capacity and the ability to bonus out some money and distribute some cash and maintain a strong balance sheet, then I would say that's acceptable.
One question that I wanted to ask Debbie, and I did when we were preparing for this, so I'm going to bring it up because I think it's a really important point, which is the subordination of the loans. And in Debbie's segment here, that's one thing that, again, was important. I found to potential borrowers was how is the SBA loan going to be viewed as compared to more conventional bank financing here? Would the SBA be willing to subordinate to other bank financing? And Debbie did mention, again, sorry about her not being able to say it in her own words, But Debbie did mention that the SBA would be very open to subordinating to conventional bank financing, because that would be pretty much a requirement from the bank regulators there that they do that. And the SBA understands that, and they are going to be much more accommodating to subordinating, which I think is a huge thing to know. I didn't know that, and I deal with this almost every single day. That's a good thing to know as you're planning, maybe expanding on different borrowings here that you'll need in the future, knowing that the SBA is willing to subordinate, because these are long-term loans. I mean, the EIDL loan is 30 years. So, we're going to be having this for a while. This is going to be impacting your balance sheet for many years to come. And right now it's here. We're talking about some specific things with Wendy as far as being able to satisfy loan covenants. But this is not, the impact of this is going to ripple over many years, even decades possibly. It's going to change the outlook for some businesses dramatically, for the good or maybe unfavorably. So the fact that the SBA is willing to subordinate, I think, is huge. Debbie, did I hit on that? I realize I'm the only one who can hear you. Okay, great, thank you. We only have about a minute or so. Here I want to get to any of the questions there. So one question I'm seeing, and it's targeted to you, Wendy, is about lines of credit. What people are seeing is that they're finding that they're paying down lines of credit. I know initially they weren't, but they're paying down lines of credit there and not using it. The concern is that going to impact their availability to have the level of lines of credit they've had in the past because of some action that they're taking this year, given them trying to manage their PPP and EIDL loans the best?
Well, I would say, I mean, bankers look favorably upon borrowers' ability to pay down their lines of credit, and I don't think it's in anybody's interest to reduce lines of credit because you've have been able to pay them down with the additional cash you've been able to accumulate on the balance sheet. I mean, after a certain amount of time, where if you haven't used the line of credit, is there a reason to keep it at a certain level if it's not needed? But yeah, I would say for the bankers perceive that favorably, for the ability to pay down the line of credit.
Okay, great.
Does that answer your question? Or?
It does, perfectly. Thank you. I know we're coming up on our time, and I want to be respectful for everyone's time, and I want to thank everyone for attending. Here's our contact information. It's been on there. If you have any follow-up questions, especially for Debbie, and I feel bad that she hasn't been able to contribute there, her contact information is there, her email address and her phone number. She is a wealth of information as it relates to SBA. So please, I encourage you to ask any questions of her. If you have any questions of me and or Wendy as well, you're more than welcome to give a call. And thank you for participating and in this webinar, and hopefully you found it useful. Thank you.
Thank you all.